Morning, everybody, and welcome to the uh, shareholder presentation on behalf of Surface Transforms, hosted by our good friends at Hardman. I'd like to welcome you all. We've got on the presentation today Kevin Johnson, who's our chief executive, and a new face for some of you, not all of you. A new face is Isabelle Maddock, who is our new CFO. So, welcome. As before, we're going to do the presentation as Kevin, but we're going to do it slightly differently. Kevin is going to break at points during the presentation to give people to ask questions in groups, as it were. Firstly on scale up, then on customers, and then we'll take questions on the finance and some of the other numbers at the end. So over to you, Kevin, and on with the presentation.
All right. Well, thanks for everyone joining. And look, we always start with a disclaimer. That's standard stuff. And David's already introduced us, so you've got the three of us today that will be available for questions, and Isabelle and I will talk through the presentation. The agenda for the presentation is this, where I'll assume you guys know us, but I'll give again a brief introduction to the company, where we're at. Then we'll talk a little bit about the Project Optimus, then on to our scale-up challenges that we've got. Then we'll break the Q&A. Then we'll talk about the business KPIs, manufacturing capacity. Then we'll have another break for customer and capacity questions. And then we'll talk through some operational stuff, use of funds, and a summary before we can then wrap it up with more questions. So that's the Q&A section, and we will drop back into this as we go along. So look, in terms of reminding everyone about Surface Transforms, we're a manufacturer of carbon ceramic brake discs for the automotive industry, principally for the performance and luxury car market. And for those that don't know about the brakes, they normally sit inside the wheel. I won't spend too much time on this, but the car has an engine to go or a drivetrain to go. And the brakes are critically important as a safety feature and also to control the car for stopping. It's a complex system. There's lots of bits that go with it. We make one of those bits that then gets integrated into the system for the car. And carbon ceramics, where they fit in that marketplace, is that all cars effectively have had an iron rotor fitted to them for stopping. And where that rotor is falling short in terms of its performance or its capabilities or weight disadvantages or emissions for that matter for brake pad dust, there's a drive to look for some alternative technologies, and that's where carbon ceramics come in. And we're one of only two suppliers in the world that supply carbon ceramics to the wider automotive market. We have a proprietary process which we can talk through at some length, but I won't be doing it here today unless there's questions on it. And that process leads us to have a premium product which has some unique selling points which are advantageous compared to our competitor. Addressable market for us is significant at 2 billion per year. And that really is only looking at cars in the sort of high-end luxury performance segment. Whether it be cars above 100,000 retail price, we would consider adopting the technology in all four corners. Cars sort of 75 or a little bit less, adopting it on the main braking axle. And when you add all those up and put a price to it, it comes to over 2 billion. And we've been progressing over quite some years in terms of our development as a company, and we now talk about having a significant opportunity for expansion and as a manufacturer. And that's being led by our success with contract wins. Our contract wins to date total over 390 million, and we have a very healthy pipeline that goes behind that, which is an addition, which is 300 million. And then really our plans behind that is all about how we then expand the capacity over the next 5 years. And really that's how, and I'll explain how we define that, but we need to get our capacity up to at least 150 million. And that will then support that revenue growth from those contracts that's already in place. That takes us right to 2027. And it's a combination of those contracts and project and the pipeline that will drive that development of the revenues through that capacity. So that's the business. Where are we right now? In terms of our strategy, we've got an immediate ambition to reach 100 million sales. And we can see, touch and feel how we get there with our customers and our contracts that we've already got. And then we've got a further ambition, if you like, and a planning scope that takes us right out to the end of the decade, where we have the ambition to reach 250 million sales by the end of the decade. What's driving that success in terms of that growth and is all about that market position we have with our product, and also the benefits of carbon ceramic brakes. And we've seen that developing and continuing to develop rapidly over time. And it's really now about we need to continue to develop our capacities, and we need to build capacity as always. We need to build it now. And having those capacity in place will drive us through with the investment we need to make, and that will be driven by profits. We'll talk about the fundraise in a minute, but we need that fundraise to support that working capital need for scale up and growth. And then we have another element that we'll talk about, which is the debt finance, which supports that capital expenditure plan over the next 18 months. And then it'll be profits that drive us through the capital expenditure plan further from there. Just to give you a snapshot of where we are right now, we are in that ramp up phase. The ramp up phase has been happening all through this year. We'll continue to be in that ramp up phase now for this year, next year, and the subsequent years. We've also added some strengthening to our team, and we've already talked about Isabelle, but we've also added a new COO. And we've identified some areas where we can improve that again, and also some lessons learned on mitigating some of the challenges we've had going forward. And that's led us to have a sort of blip in our ramp up, and that's led us to talk about where we have to recover that and continue that ramp up. So we've got sales expectations for the next quarter of 3.3 million, of which we had our best month to date in October, which is 1 million. Now, in terms of Project Optimus, there's two elements to this. First one is an equity raise, looking at raising 8 million as a placing, which we've already completed with the 2 million open offer, which can be extended if need be. And the second element is the capital expenditure debt facility. There's a bit of detail behind those, and I'll hand over to Isabelle just to talk through a little bit of detail around why we've got two elements and what they're for.
Yeah, there are two very important elements to this program of basically giving us increased financial strength. That, the company is of a certain size at the moment. We have two challenges. One is production capacity, and the other is our limited size and financial strength. And this gets us over the hill. As Kevin said, our proposed placing is really to support the working capital requirements of the business here and now and today. So we've had a year of scale-up challenges, which I know Kevin will cover in the next slide. And that's been against a year where we have resourced ourselves in order to increase our production capacity and our level of sales and operations as we go into 24 and into 25. And it takes a significant amount of resource to do that. And so the working capital facility is needed to, just right now, as we're hitting that ramp up, we've got a much steady and resilient curve that we're going through right now and into Q1 of next year. And by about Q2 of next year, we expect to be no longer burning cash and to be in a more profitable position. And then into the second half of next year to be actually be profitable. So that's the working capital facility that will help us get through that. The debt facility is really interesting. We have a £44 million capital expenditure program over the next 5 years. And we need 13 million or 14 million of that, in fact, on another slide, to just complete the 75 million capital expenditure program, which is about installing up to 75 million of capacity on the existing site as it is now. Now, the debt facility is imminent. It's very advanced in its stages, and it's a 5-year loan, which is purely for capital expenditure purposes. And we can talk about this a little bit more later, but I think the key headlines for us are it really is for capital expenditure purposes, which I think alludes to one of the questions that somebody wanted to ask. It can't be used for commissioning. It does suit us very, very well in terms of it pays for the capital expenditure that we have committed to in advance of us needing to pay the suppliers. So it really helps our cash position. And we have 2 years upon which to draw that. So there's no immediate rush. Other than our own pressure that we put on ourselves to get on ahead and get this building done, because by giving ourselves this additional capacity, we give ourselves the increased resilience and ability to meet production requirements.
Okay, if I move on to some of the scale-up challenges, look, we started the year in 23 where we'd installed the capacity for phase one at 20 million, but we had some issues with some furnaces. And we resolved those issues over the sort of first quarter into the second quarter, where we did a bit of a redesign of some of the linings within inside that furnace and put that to bed. That allowed us to sort of continue the road of our ramp up through the first half of the year. And we made some steady progress, and that technical issue hasn't come back and hasn't had to be resolved subsequently after that. But in quarter three, at the end of quarter three, we found ourselves in a position where we had a second rather than a capacity issue. It was utilization of that capacity, and we had some single point of failures within our production line. Now, for those that aren't familiar with our process, we have about 30 steps within the manufacturing process, and some of those, we have one production line effectively. Now, some of those steps have just one machine that delivers all that capacity. When we count up how many of those steps there are about 7 which deliver that production line that have a single point of failure risk. We had 2 of those go down at towards the end of quarter three, and that really stopped us in our tracks, where it stops the line. We can't produce. We then had to go through some work to bring those back into service, and that took us a little bit of time because there's a learning curve that we're going through in terms of how these machines are used. They're unique to us. They can deliver what we want them to deliver, but it's delivering what we want to deliver and then maintaining them and keeping that uptime as we would like it to be. And as part of that, the maintenance team are working through all of those complex pieces of equipment and learning how to be more predictive with their planned maintenance rather than reactive. But nonetheless, we had 2 of those pieces of kit go down, and that really caused us an issue in terms of our output at the end of quarter three. And it's that combination then of disruption to our production line that is causing us to not be able to utilize all of our plant capacity that we've got installed. And one of the things to mitigate that is obviously building more capacity, which we've been getting on with. That's phase 2, and we started that in 2022, and it's been coming through 2023. And that capacity will effectively give us more pieces of equipment to reduce those risks of single point of failure. And they are coming in. So we've got some of those coming in right now. Some of them did come in September, October. There's a few more still to bring in before the end of the year and into January, and we'll commission all of those, and that will start to deliver that additional risk mitigation for any single point of failure as we enter 2024. What we'd also have liked to have done is have some buffer stocks in place or Kanbans along the production line. And those are there to smooth out any disruptions that are in that production line. Now, we've not been able to build those buffer stocks because we've effectively been using the capacity that we've had available for us as we've been moving the year doing the ramp up. So again, the mitigation to this is to try and build and get ahead of that capacity curve and build more capacity to allow those buffer stocks to be built and effectively overproduce in certain areas. And then if we have planned maintenance or unexpected downtime, we feed those buffers in, and that smooths out the flow and ensures that we can continue to do the output we're expecting to do. And the third risk we had is around the maintenance learning curves. I've mentioned already about the complex equipment. Those guys have been working very hard trying to be reactive and bringing things back into service and using them again. But it's fair to say that we're going through that learning curve to convert that knowledge, because it's not available from the equipment manufacturers. They don't understand our processes and how they work with their equipment. It's more for us to develop that knowledge and then be able to put in the systems and the planning to be able to do the maintenance in a timely manner and effectively get better efficiency and better utilization from our capacity. And we're doing that. We had our best month to date was in October at £1 million, and we expect to sort of make steady progress now and get back on that ramp as we go through quarter 4 and quarter 1 next year. We won't be able to recover that ramp to where we would have liked to have been, but we've effectively worked with our demand and our customers to rephase that so that we can build up that ramp through 23 into 24 and then deliver to the customer expectations that we've got as we enter the new year.
What are you doing to increase management bench strength which has clearly been a major failing within the company. You mentioned that, but perhaps you could just
let me talk a little bit more. So, and we've actually got some slide on this later in terms of operational stuff. But look, there's no doubt we recognise that we need more firepower, and not least we've recruited a new CEO in Stephen Easton. Stephen's background, for everyone's benefit, is he spent, I think it's over 15 plus years with SGL Carbon, as responsible for the manufacture of carbon fiber and running those plants. So he's an engineer by training, so he brings with him all the expertise that he's developed in manufacturing, all the engineering expertise. He's a fantastic guy to have on board. And he also brings some relevant knowledge and industry knowledge, because the first half of our process is all about producing carbon in fiber form and other forms. And so he's able to bring that knowledge he's already got and help us with some of the processes that we already do. So but we've also looked at the operational team as well. We've strengthened that operational team. We've restructured it. We've upgraded 4 of the managers. And then the piece around maintenance, there's a whole piece of work where we are looking at trying to broaden out the skills and expertise, because we have the right skills and expertise. We just need to expand out that expertise into the business. As we've been scaling up the people, it's been important to try and get that training into everybody rather than just in the core people that we've had before. So those are all the things we're doing to, if you like, give us more bench strength and to address any future challenges we might have.
Is there a comprehensive plan in place to stop the scale up production issues?
Well, there is, and that plan, we'll talk about the capacity plan. If you say what deals with those production issues, well, principally building more capacity will deal with it and give us that headroom in terms of capacity that we're looking for, and that's really where phase 2 comes in. But our planning cycle is effectively 2 years, 18 months to 2 years. So we've made a lot of decisions on the scale up of capacity that we made back in 2021, and we ordered lots of different pieces of kit. Those kits get fabricated and built by the supply chain. There are uncertainties in the plan in terms of the delivery of those things from the suppliers, and there's been challenges there which we've talked about in the past. But generally, then the plan moves forward and we bring those pieces of kit in. But the decisions we've made are 2 years old, if that makes sense. So if we are predicting where our demand is going to be and where the customer demand is coming from, we have to make that judgment call to say, have we built enough capacity to try and get ourselves ahead of that demand curve? And arguably, we would love to have more capacity now. We haven't got it. And phase 2 will give it to us, but it won't be with us this year, but it will be with us. And the plan tells us it'll be with us progressively as we move through 2024.
Has Surface Transform sought external production and reliability expertise to reduce the reliability issues it continues to experience?
Well, the simple answer is yes, but the simple answer is also no. We have where we could seek external expertise, we have. So in certain processes where there is a universe out there that perhaps understands that process we're doing with that equipment, we have brought people in, and we have brought those specialists in to help us with those pieces of work. But there are a significant number of processes and equipment that are bespoke to us, that there isn't a universe out there of people who have the experience of it. So that's where we've not been able to go out and say, well, we'll go and find somebody who knows how to do this. Frankly, that's us. And we then had to rely on our own expertise and our own abilities and training and experience to then develop those processes for the ramp up and scale. We've got our list on the left-hand side of this slide, which talks about 6 OEM customers, and that's unchanged. When we look at some of the graphs, the top 4 graphs, one of them is contracted OEMs, and you can see that's being maintained from 2022 to 2023. Sorry, it's at 6. But we also measure then with those customers how many contracts we've been awarded. And you can see there's been very steady, good progress over 21 and 22. And we talk about having 12 model contracts awarded. But I think what people are probably more interested in is the relationship and the strength of that relationship with the customers that we've already got, those existing customers. And we do measure that by how we talk about follow-on contracts. And those follow-on contracts there's a desire from our customers, and where they invest a huge amount of energy, costs, people, time, all those things in the development of our product for their platform or car, and then how they integrate it into their systems. And so there's a real desire to say, well, once they've done that and you're in the parts bin, how do you then leverage that technology and product for future cars as well? And so we always look at it, and they look at it to say, what are the follow-on models that can come? So we measure it, and we're now at 5 follow-on models from our existing customers. So out of those 12, nearly half of them are follow-on models. And that gives you a good indication of, one, how good the product is for the customer and how highly regarded it is, but also the relationship where even if they expect challenges on ramp up and scale up, but their plans are very much fixed in terms of what they want to do. And frankly, they want to be able to follow on with future contracts, which is what gives us the confidence in terms of not just what we see today in what we've achieved in contract wins, but also in terms of our pipeline. And so when we talk about contract values, yes, we've got contracts worth 390 million. And it's interesting when you then transfer that into what's our effective annual contract revenue when they're all in series production, it ramps up to 79 million. So that tells us we need to build capacity beyond our 75 million footprint. And we've got high confidence with our customers and the relationships, the product, the pipeline. We keep converting that pipeline into contracts. So currently we've got 300 million in that pipeline. And again, that's worth about 50 million in terms of its value per year as a revenue. And that tells us that if we're successful in converting that pipeline to add it to our contracts, it comes to just shy of 130 million in terms of what's ahead of us. That's what's driving us to then dictate what our capacity build is and the plan. Coming back to that detailed plan, we then put our detailed plans together to say that we need to be able to get ahead of that demand, and we want headroom in there. So hence 150 million will get us there. Now, just talking about customers and linking it to that ramp up, the other graph in here on the top 4 is contracts in series. Whenever a contract is awarded, there's normally a 2, maybe 3-year period between contract award and seeing the series revenue start. There is a bit of development revenue during that period, but it's relatively small. You start to see the big revenues come when you go into series production. And we've seen those cars start to go into series production as we've gone through 21, 22, and into 23. And we now have 5 of those cars in series production. And we're supporting, with our output today, we are supporting those 5 contracts that are in series. So we expect that to continue. We've got at least another couple, perhaps 3 in 24 that will go into series. And that's what's driving the continued ramp up through 24. And similarly in 25, there's 2 or 3 more. And then there's one which we announced recently, which is another follow-on contract with OEM 10. With that announcement this year, we're not expecting that to go into series production until the end of 26, perhaps even 27. And so the integration work and the engineering work and development work will continue in the background with those. So we expect our ramp to continue. The customers are with us. When there are challenges, and this is where we're talking about the challenges we've faced on scale up, the customers do not look at it and say, well, this is not what we want. They've invested a significant amount of time and money. They're not willing, they don't want to, or willing to, or can afford to go elsewhere, or do something else that would require them to go through the whole integration piece again with our competitive product. So it's really about us working together to overcome any challenges we have in terms of our ramp up. And that's what they do. They come and help. So they spend time with us. arguably coming back to the question about whether I've looked outside the company. Our customers come and spend time with us and understand what the challenges are. They then try and help us. Not significantly, they're not helping us really with the technology because they accept that's not what they know. But they can help us with how they've done scale up before and ramp up before with other suppliers in their supply chain, because this is nothing new to them in terms of having to build up capacity and deliver to a demand that's out there from the customer base. And I suppose the last piece on this slide is we still are engaged with other customers, but that's not our focus right now, just to give everyone a clear message. Yes, there are other opportunities out there. Virtually all of our pipeline is with existing customers, and our focus has to be on building capacity, executing our plans. And if there are opportunities coming, yes, we will engage with the customer to talk about them, but that doesn't necessarily mean that's what we want to be doing right now. We've got enough on our plate with what we're doing with our contracts awarded and the pipeline in place to be getting on with. And anything else, it might be interesting, but it's not the priority. So that links me to the capacity, and we've been working on our capacity plans for a number of years. We've got the capacity of phase one installed and in production. That's what we're using today to do our ramp up and do our output. We've had that issue in terms of utilizing the capacity, and that's been slightly delayed with the ramp up, but we are recovering in Q4, and that'll continue into 2024. Alongside that, it's all about getting more capacity. That's where phase 2 and phase 3 come in. And phase 2 is getting our capacity up to 50 million, first of all. And that's what we've been investing in for the last sort of 18 months. And that investment is all but done. There's a little bit left to do as we enter 2024. And that'll see that capacity start to come on stream, and will support production in 2024 and give us some more capacity resilience that we're looking for. And we've already begun effectively then ramping that up from 50 to 75 with the investment this year, which will continue as a capital investment program next year, so that we can have the 75 million available to maintain that headroom and capacity resilience we want and to support production in 2025. And then following on from that, there's phase 3, which is the next phase. Now, our site, if any of you are familiar with our site is only capable with the footprint we've got to get to 75 million. So to ramp up beyond 75 million to the 150 million requires additional land and buildings. We've done the work on that, so that adds more time to the plan. So we don't want to be doing that inside our 2-year timing plan, because we need to have all plans laid out in terms of where things are going to go, how we're going to do it. We've done the work on that. That's all but finalized in terms of taking on some more land and some buildings. And it's effectively an extension to our current site. So our current site is about 3 acres, and we would just extend the boundary of our current site to an additional 2 acres, which has some buildings already on it that we can then utilize, and some land we can utilize for the kit as well. So all of that is in place to then take us right to 75 up to the 150 million, and the investment plan is there to support it.
So we've got the 75 million installed capacity that's absolutely necessary and is planned for the next 2 years. Our own models demonstrate that actually we can have the bulk of that done in terms of 13 million spend by the middle of 2025. Now that 13 million contributes towards the 75 million installed capacity, with a little bit to continue into the end of 2025. And it also contributes to the 150 million installed capacity, because in the middle of 2025, we will have to start putting some deposits down and start to actually commission some of the larger pieces of kit to ensure that we have them in time for 26 and 27.
What has been the reaction of the customers to the production difficulties we've had? And I could add in that is how long does this go on before they just walk away? The reaction of the customers when you have these production difficulties is they send teams in to find out what the source of the problem is. And essentially, the customers see our production problems as capacity issues. And the debates we've been having with them have all been about the speed at which we can introduce the new capacity, how we introduce the new capacity. And they've actually been very supportive. They understand it, as Kevin has said. They are professionals in this world, and they know how it is. The other question, which was also asked in the same way, was, will they just walk away? Well, as Kevin said, the risk in the relationship is not about the current business. The current business is largely determined by the realities of the engineering system integration. Once you're on a car, you're on broadly on that car until the car finishes the production life. The relationship issue is the next job. Do you get the next contract? And that's why it was so, I don't know the word I'm looking for, it was so refreshing, interesting to see that really new follow-on award we had a few weeks ago from OEM 10, that showed that they were staying with production capacity, and they were prepared to go forward with us. So it is an issue. They are concerned. They do diligence all over us. They spend their teams. They have teams that do nothing but this, and they come into the plant and work.
It's in a very proactive way, though, isn't it? And it really is about working with us, rescheduling what we can achieve, and ensuring that we can deliver as maximum as possible to meet our customer needs.
As Kevin has alluded to, what we're seeking to do about it, and this was a partial answer to the question that happened before, is to do we have a comprehensive plan? And our plan for dealing with the issue splits into three elements. What are we doing about the people? What are we doing about the process? And what are we doing about the systems? As we said, we have increased the management strength. We've very much changed the operational team, upgraded it by 4. In fact, I think there's only 1 or might be 2 of the senior management team in production that was there a year, 18 months ago. We're doing quite a lot of work on maintenance and restructuring the maintenance team and that, and doing some training initiatives to support that. In terms of process, we're doing process for us exists at 2 levels. The process within the individual furnaces and what that means. And we're doing, as everybody knows, quite a lot of work in that area. But it also means the wider issues about preventive maintenance and the other things that are relevant in a factory, total quality. And the one thing that Steve Easton has brought to us since he's been on board, he's only been on board 10 weeks, has been what I call the plumbing within the factory, the need to pick up and run with some of the basic issues that make factories run. And we're very pleased with how that's been going. And of course, training within that. But above all else, trying to get the people involved in Kaizen events. We've also been doing quite a lot of work on improving systems with our KPI management and the management team, and doing work with our SAP.
I mean, this is a great slide to recap where we're up to. You know, the raise today is about working capital and raising our working capital needs, or supporting our working capital needs, particularly now and over the next 6 months. That gets us to a position where we are financially stronger and able to weather the storm. And the real ramp up is in the next 6 months, as you saw from that curve that Kevin showed, and that calls on our working capital needs. The capital expenditure program is fundamental to where we need to be in the future, and it's already in hand in terms of the build. We do not want to pause on that working capital program. It is absolutely critical to give us that resilience and additional capacity, ability to build buffer stock, as Kevin mentioned, because when you're running a factory and if one machine goes down, it's really important that we can continue with all the other operations and still get good products out of the door to our customer, and that's what matters. And bringing in the additional equipment and getting that online and running is really important to us. and to our customers. The capital expenditure programme will be funded in the first instance by a debt facility. The debt facility is a facility which is actually EU-backed funding. It's a facility solely for capital investment. It is a 5-year facility. It is available for the first 2 years. And what that means is we do not have to draw it down immediately. We have up to 2 years to utilise it. In our plans, we will utilise the 13 million within the next 18 months. However, it's good to have that headway of the additional 6 months to the end of 2025 in the event that we're delayed by supplier choices, or we choose to actually pace it a little bit slower because it's necessary to be to do that. So it's good to have that leeway. After 2 years, we do draw down. We will have fully drawn down the facility, and we will be in a repayment position. There are no penalties for fully paying down the debt off earlier should we want to do that. So overall, the fundraising structure, we've been in essence successful with the 8 million fundraise now with our shareholders, with the second tranche of that coming on the 18th of December, subject to shareholder approval. And this is a great opportunity to open up that offer to our loyal and trusted retail investors and those who want to continue to support us in this journey that we're on.
Let me just deal with a question that's come in from somebody about the open offer, and I can't find it. I can't find the name, but I can remember the question. The question was that it is dilutive, and we're only offering 12% of your shareholding to the open offer, and I want to deal with how we've done that. I mean, we think our retail, the people who participate in the open offer, the retail investors, we think is something like about a quarter. It could be a third of our shareholder base, and therefore, what we've sought to do is give something between, in effect, a quarter and a third of the fundraise and the opportunity to the retail base. So try and make it to that extent pari passu. So the size, we generally try to be fair with the retail investors here, that the opportunity between 2 and 3 million to participate in that open offer will not be dilutive to those who participate. Self-evidently, it'll be dilutive to those who don't participate.
Yeah, so David, do you want to just expand on that? That on this page, it does say up to 2 million, which is what we initially did in terms of that 25%. But in fact, we do have discretion up to 3 million should we want to.
Yeah,
and should the retail investors want to support us up to that amount?
That clearly depends on
appetite.
On appetite, yes.
Yeah.
If I talk through the investment summary, the message here is we are on a ramp up, and there are challenges with our scale up and ramp up. It's all about getting capacity resilience and building that capacity resilience, which includes building up more machines, single point of failure, getting some buffers in place as we move through 24, getting those learning curves embedded, getting the teams trained out, all of those things from an operational perspective. So it's all inward looking. We've got phase 2 capacity coming through, and that is to support those customer contracts that we've got in place, because the pipeline is worth an additional 50 million per year as revenue as well. We are talking about this equity raise in combination with the debt finance, and hopefully you've got a flavour for the reasons for the equity raise to support that growth in terms of working capital requirements now. But in addition, the CapEx investment plan can be supported in the next 18 months or so by that debt finance plan we've got in place and are finalising. And that leads us then through to saying, as we continue that scale up and ramp up, we then move into profitability. And that profitability then helps us with generating some cash, which then supports the investment plan going forward right out till 2025, because all of these contracts are multi-year. They're all in place. The customers are with us, and the gross margin at 6% is healthy. What we need to support that investment plan going forward. And it's all of that put together that allows us to then say, with this equity raise, with the debt finance, and the delivery of the scale up, we have what we need, and we don't need to raise any further equity going forward.
Is the debt facility actually signed? And then there's another one here that says, can you say something about the effective interest rate on the CapEx loan? I don't know how much of that's commercially confidential on the interest rate, but if it's not, please share.
Well, a couple of things there. It will be signed by the middle of December at the latest, because it's EU-backed funding. So that's the hard stop deadline, and we're working actively with the stakeholders to get it signed as soon as possible. In terms of, it is a commercial loan. And so what that really will mean for us is from after drawdown, let me rephrase that. What that means for us is we will be paying a commercial rate of interest on anything we draw down. Anything that is not drawn down, it's an incredibly low interest rate. So we don't pay a significant uncommitted fee, if you like. And obviously we've done modelling, and you'll see the projections that are out there. The interest charge on the company does go up, but it is within our models and we can afford it.
How can we have we raised sufficient money to handle the capacity over the next, presumably 2 years or something, without losing control of the company to an opportunistic private equity company or want to take over from a much stronger company? Do you want to deal with the headroom and that side of it and I'll deal with the private equity?
Yeah. No, it's a great question, and it's a very, very interesting question. I mean, our plans are clearly greater than those that are projected out there, and we have intentionally been cautious this time. At a lower rate of growth, there's less call on working capital, so we get the headroom that way too. We also have opportunities, mechanisms that we've not built into our plans, which we can call upon if we want to. So we could do something with our debtors line as our debtors line grow and accelerate cash into the business, which gives us greater finance. And we can also just, if we choose to, slow down the capex and the pace of growth, so we do not overcommit. So there are levers that we can use in the event that plans do not go at the pace that we want them to go at during 24 and 25. With the figures that are out there, we've got enough headroom. Clearly, we do sensitivities even below that to ensure that we can, kick the tires on the business model at a worst case. And the sensitivities give us those headroom and a very clear mechanisms that we can call upon should we wish to do so. And we may choose to call upon some of them anyway. What was the second half of the question, David?
I'll take the second half of the question, because there's asking why don't you sell to a stronger? It says, why don't you sell to a stronger, bigger company? And another one saying, isn't the risk that we sell to a bigger, stronger company or private equity? Look, I always say that you shouldn't be asking the managers or even the board about the question of private equity involvement or a stronger company coming in, because that's not in our control. What I would say is that the numbers that are in the public domain of, is it 20, 40, 60, 80 million of sales, it's that sort of rate of growth over the next few years, are real. The larger shareholders, the ones who will determine this, fully understand that, are bought into it. And whatever happens, the value of that, call it 20, 40, 60, 80, they may not be the precisely correct numbers, would have to be reflected in anything that that anybody wanted to do. So are we at risk? Any company that's on AIM is at risk, fact. And indeed, you can see that in terms of takeovers. But what I do know, because I've spoken to them, is our largest shareholders are very supportive of our long-term ambitions. And you saw that in the fundraise, if I may say so, where our largest shareholders contributed more than their fair share. Some of you'll see as the RNSs come out over the next few weeks, some of them have actually increased their share in the business. So it's an issue for us. It's a concern, but it's not a very immediate one. Kevin, I don't know whether you wanted to add anything to that, because you've been involved in some of those discussions.
No, like you, it's not in our control. Frankly, we should get on with what we're doing, and if there's anything that comes up, then obviously we'll deal with it in due course. But we should be focused on the job.
Yeah. Well, actually, that segues very nicely to a question from Abhay Rachura, what does management see as the top 3 risks to delivery of a business that can deliver sustainable, positive free cash flow? Kevin.
Yeah, well, maybe I'll go first, because I know he's asked for the top 3, but I'm just going to say the same one 3 times, which is it's the execution of our capacity build, and you could break that down into the installation of capacity and then the ramp up and utilization of that capacity. But our biggest risk and our biggest focus is on the execution of this business. We've got a fantastic position we're in with customers, contracts, products, all of those things. The position is great. It's all about the execution now.
I agree with that. Execution, and we've got to get on with it. And and by the way, there's a few comments about our performance in here, and you know, we are self-evidently not happy with with what's happened over the last 12 months. We can give you 100 excuses. That's not helpful. What we do know is that we have a broadly large, newish team in place working assiduously on fixing these issues, and are confident they will be fixed. Can I just deal with something else under this general heading? There's one from, and I think it's a misunderstanding, from an anonymous attendee, that's how it's pronounced, who says that we have given the impression there'll be no news flow over the next 12 months. And of course, if we do so, we'll continue to be in the dumps. And it's hardly an encouraging message for shareholders being badly hit over the last 3 months. As a statement of the obvious, we make statements when we have something to say, but actually it so happens that the way the calendar works out, we always have to say something about every 3 months anyway, because in March, April, we'll be producing the results for the year we're in. So we'll be out with a statement then. We have the AGM in June-ish, June, July. So we do a presentation and shareholder presentation then. We have the half-year results in September. So there is a natural pace of announcements anyway. And whilst we don't have, there will be customer announcements. I don't know what they are at the moment. There will be customer announcements over the next year. So please be assured we're not going to sit on our hands for 12 months and say nothing or do nothing. One of the questions is, why did management not be more conservative, i.e. under promise and then over deliver instead of the other way around? Kevin, can you answer that one?
Yeah, look,
it's coming in a few guises.
Yeah. Look, I think, that's the situation we would always like to be in, but we've got to be mindful of the customers here, and it's the customers that are telling us what they want, what their demands are, what their timelines are, and that's what we're trying to, going back to the risk and the execution, that's what we're trying to execute against. So I think our focus, and rightly so, is on the customer side of things, and therefore the expectations are set from customers rather than from being able to set a relatively low expectation. So my take on it is we've been boxed in a little bit by what is clearly a success story, which is snowballed and developed quicker than perhaps everyone would have expected. But nonetheless, I accept the point. It would be much better to underpromise and overdeliver, and that's something we're looking to try and do. But we have certain constraints that we need to work to, and that's, we have to be mindful of those as always, which is customers.
Isabelle, I know this is something you feel strongly about because you've talked about it since you recently joined us. I don't know if you want to add anything to that.
Well, I always like to strike a note of caution, but I guess it's very evident that we've learned a lot, and one of the things is Kevin mentioned it earlier. We're taking equipment in, but we are redesigning and reconfiguring equipment in order to get them more efficient to meet production. And as we're doing that, We're also learning how hard we can run the equipment and what the maintenance programs are. And when a machine goes down, it hits us hard at the moment. I can see us being more reliable with our equipment as those machines are replicated, and we get that opportunity that I can see in the next Q1 of really having more reliable equipment and therefore more reliable forecasts.
Okay, Kevin, we're running up to the hour, so we can only take a few more questions, and I'm just taking them off the list. But there's one here. Let's at least not quite conclude with this question, but let's strike a very positive note. Is what feedback do you have from customers who have taken delivery in 2023 and sold cars with our brakes? What are the customers telling us about the what they think of the product?
Yeah, well, that's a great question, and we get fantastic feedback. First of all, let's talk about the quality of our products, and we don't have any returns, any field failures, so that's a big tick in the box from ourselves and from the customer's perspective. But then, in terms of the product's performance, what it does for the customer's product, which is the car. The view is it's fantastic, and it exceeds their expectations, which is great to hear. And frankly, you don't hear that often from a vehicle manufacturer. So they're very good at telling you where you need to get better. So to hear them tell us that it's been very welcome, and it's really encouraging because we know we've got a fantastic product and our customers agree with us.
Isabelle, there's a question here about return on investment. It's in from Murray Jacobson. In previous meetings, you've mentioned 40% ROI. If you need extra capacity as a buffer to lower output yields, is that kind of return still achievable?
Yes. Yeah.
I'm going to say, yeah.
Yeah, I mean, the future's bright, but the challenges cannot be underestimated, as we've described. It's all about getting good quality sales and increasing that each month to meet customer demand. And it might still be bumpy as we develop our processes to get there. However, the returns are very attractive.
Thank you very much, everybody. And I suggest we close the presentation with that. Thank you, and good afternoon.